Welcome back to Iron Financial. This is the channel where we help you forge a stronger portfolio because we cut right through the market weakness. Today, we are putting Smith Douglas Homes, ticker SDHC, under the microscope. They just dropped their Q4 earnings report, and really, the whole thing boils down to one simple question. Are they building a fortress, or is this thing just a house of cards waiting for a light breeze? And calling it a house of cards, that might be putting it nicely. This is a stock that has been absolutely punishing its investors. So going into this report, shareholders weren't just hoping for good news, they were practically begging for a life raft. Let's find out if management threw them one, or just another bucket of water. Okay, let's just get right to it. The number on your screen tells the entire story of the past year for this company. A 52-week performance of negative 34.86%. Look, that's not just a rough patch. That's a catastrophic failure of market confidence. If you were a long-term holder here, every single day for the last year has just been a slow, painful bleed out. This is the enormous weight they were carrying into this earnings call. It's a massive, flashing red light that screams something is fundamentally broken here. But then the report hit the wire. And what happened? Well, you're looking at it. In after-hours trading, a pop of 3.05%. Now I know what you're thinking, skeptic. It's not a massive, life-changing jump, but it is not nothing. After a solid year of relentless selling pressure, the market actually read this report, and for the first time in a very long time, the buyers stepped in. The bleeding stopped, even if just for a moment. That tells me there was something in this report that broke the negative momentum, like finding a solid piece of rebar in what everyone thought was crumbling concrete. In that right there, that is the central conflict we need to dig into. What is the market really seeing? Is that little 3% pop just a classic dead cat bounce? The final twitch before the stock continues its long slide into the basement? Or is it the first solid foothold in a long, hard climb back to recovery? Is this the beginning of a real turnaround story, or is it a cleverly disguised value trap, just waiting to lure in hopeful investors before the floor completely gives out again? That's what we are here to forge today. So to get to the bottom of it, we have to tear into the numbers. And right away you can see they tell a conflicting story. This thing is a house divided, plain and simple. On one side you see some serious signs of decay, of real market pressure, but on the other you see glimmers of strategic strength. We have to inspect the entire foundation here to figure out what the true structural integrity of this company is. And let's not forget the recent history here. This isn't their first go-around with disappointing the street. Just last quarter, Q3 of 2025, they missed their earnings per share estimates. What happened? The stock dropped over 6%. A pattern of underperformance isn't just a concern, it was firmly established. So you better believe that going into this report, investors were braced for impact, expecting more of the same. And yet, this is what they delivered. A clean, solid beat on both the top line and the bottom line. Now, what's really important to see on this slide isn't just that they beat, but by how much. Look at that EPS number. The analysts, the so-called experts, were calling for 12 cents a share. The company came in and delivered 39 cents. That is more than tripling the consensus estimate. That's a blowout. On revenue, they were expected to pull in around $251 million. They cleared that easily, hitting over $260 million. On paper, this is an absolute, undeniable win. This is the core of the bull case, and it's almost certainly the fuel behind that after-hours pop we saw. Whoa. Let's pump the brakes here. Let's apply some real pressure. Beating an estimate of 12 cents a share, that bar was so low you could trip over it. To me, that says one thing. Analysts had zero faith. They are pricing this company for an absolute disaster. So, is sprinting past a catastrophically low expectation a real sign of fundamental strength? Or is it just a sign that Wall Street's expectations had cratered so badly that, frankly, just keeping the lights on would have been seen as a victory? I'm telling you, it's the latter. This isn't strength. It's just better than abysmal. That's a fair challenge. Let's move past the Wall Street games then and look at the hard, cold numbers themselves. Let's start at the top line, the revenue. I call this the revenue wall. It's the company's first line of defense. So the real question is, how did that wall hold up against a very, very tough market? Now, looking at this chart, you can see the wall definitely took a few hits, no doubt about it. Revenue from their home closings in the fourth quarter came in at $260.4 million. That's down from $287.5 million in the exact same quarter last year. So yes, it's a decline and we can't just brush that aside. However, you have to consider the environment. In a housing market that's defined by crippling affordability issues and absolutely brutal competition, a single-digit percentage drop isn't a total collapse. I look at this and I see resilience. They're holding the vast majority of their revenue base steady, even in a storm. They bent, sure, but they didn't break. I'm looking at a 9% year-over-year decline. I don't call that resilience. I call that erosion. That is the market literally chipping away at your business, brick by painful brick. A nearly 10% drop in revenue is a significant blow, and it leads directly to the next, more important question. How many fewer homes are they actually selling to get to that number? What's the unit volume look like? And this slide right here perfectly illustrates the divided, almost schizophrenic nature of this report. For the full year of 2025, Smith Douglas achieved a company record, 2,908 homes closed. That's actually up 1% year over year. I mean, let that sink in. In one of the toughest years for housing in recent memory, they managed to sell more homes than at any other time in the company's entire history. That points to a rock-solid operational engine, and it tells you they have a product that people still want even when money is tight. And I'm looking at the right side of the slide, because that's what's happening right now. The full year number, that's history. It's backward looking. The fourth quarter number is our most recent data point, and it shows a 7% decrease in closings. That's a clear signal of weakening momentum as we head into the new year. The trend is not your friend here. So yeah, they may have set a record for the year, but it looks like they limped across the finish line. That's a really concerning sign for what 2026 might look like. Exactly my point. The revenue, the closings, that's just the facade. It's the pretty exterior. Let's get to the real guts of the operation, the part of the structure that actually holds the whole thing up, profitability. And this is where I see severe structural problems. We have to talk about the margin squeeze. This chart right here, this is Exhibit A for the entire bear case against this company. Home closing gross margin, it didn't just dip, it plummeted from 25.5% in Q4 of 2024 all the way down to 19.9% in Q4 2025. That is a catastrophic collapse. We are talking about a nearly 600 basis point compression in a single calendar year. To me, this is the single most alarming number in the entire report. It tells you that for every single dollar of revenue they bring in, they are keeping way, way less as actual profit. The engine might be running, but it is leaking oil all over the place. Okay, I have to agree with you here. There is no spinning this number. It is what it is, and it's bad. This is the heavy lifting number for the bears. Absolutely. This margin compression is the single biggest weight chained to the stock, and it's the number one reason it was down 35% over the past year. This is the metric that has investors waking up in a cold sweat, terrified that the entire business model is cracking under pressure. So, why is it happening? Well, here's the why, straight from the horse's mouth. Management says they're fighting a war on two fronts. First, you have aggressive competitive discounting. That means every other builder out there is slashing prices to move inventory, and Smith Douglas has no choice but to join the fray. Second, you have affordability challenges. It's no secret mortgage rates are high. Buyers are stretched thin. So to get a deal across the finish line, the company is forced to throw in incentives and cut their asking price. Both of those things are a direct assault on their gross margin. Let's just call it what it is. Management is admitting they're in a race to the bottom. They are actively sacrificing their own profitability just to keep the production line moving. You have to ask yourself, how long can companies survive doing that? A business model that depends on giving up more and more of your profit on every single transaction? Well, that's not a sustainable foundation. That's a short-term band-aid that creates a massive long-term structural weakness. And for anyone watching who might be new to this, it is absolutely critical you understand this term, margin compression. It simply means the profitability of every sale is getting smaller and smaller. As this slide lays out, it happens when your costs, whether that's raw materials, labor, or in this case, discounts and buyer incentives, are going up faster than your sales price. It is the financial equivalent of trying to run up an escalator that's going down. You have to work twice as hard just to stay in the same place, and more often than not, you are slowly but surely losing ground. This is the central problem, the absolute heart of the debate over Smith Douglas homes. Okay, you're right. The margin pressure is real, it is severe, we've established that. But what if it isn't a sign that the building is collapsing? What if it's actually a symptom of something bigger? What if all this short-term pain is a necessary, calculated cost for a much grander, long-term strategic plan? The bull case here argues that while today's margins are getting squeezed, the company is simultaneously forging a much, much larger future for itself. Look at the blueprint on this slide. While everyone was wringing their hands about the margins of today, management was busy executing this plan for the revenue of tomorrow. Step 1, they grew their number of active communities by a massive 28%. Think of those as their storefronts. They just built a lot more of them. Step 2, they expanded the number of lots they control by 14% to over 22,000. That's their future pipeline of inventory locked and loaded. And step 3, they're actively deploying capital to buy the land and the materials they need for all this growth. Look, these are not the actions of a company that's in retreat. These are the deliberate, calculated investments of a company playing chess, not checkers, and they are willing to absorb short-term pain to gain long-term market share. And that really is the million-dollar question, isn't it? Or I guess in this case, it's the multi-million-dollar question. How on earth does a company with profitability shrinking by the day, with margins getting squeezed from every possible angle, suddenly find the cash to fund such an aggressive and very expensive expansion plan? That money has to come from somewhere, and that usually means one thing. And here is your answer. It's coming from debt. Look at these numbers. At the end of 2024, Smith Douglas was practically debt-free. Their debt-to-book capitalization, which is just a fancy way of measuring how much debt they have compared to their net worth, was less than 1%. Now look at the end of 2025. It jumped all the way to 9% in a single year. And this is where my house of cards analogy comes roaring right back into the picture. This is a huge risk. They're piling on debt at the exact same moment their ability to generate profits from their core business is deteriorating. It's a classic squeeze. If the housing market gets any worse, they're going to be stuck with higher interest payments and falling income. That is a fundamentally precarious and very, very dangerous position to be in. But from management's perspective, they're calling this a conservative approach. For a home builder, a 9% debt-to-book ratio is still considered very manageable. So they don't see it as a desperate gamble. They see it as a strategic injection of fuel. It's the capital they need to secure a much larger footprint for when, and they believe it's a when, not an if, the market finally turns around. Okay, so that brings us to the final segment, the big one. We've examined the foundation, we've identified the cracks, we've also reviewed the new blueprints for the expansion. Now it is time to weigh all of the evidence and forge a final verdict for all of you watching. Is Smith Douglas Homes a deep value opportunity waiting to be uncovered, or is it a classic value trap waiting to spring? From where I'm sitting, the evidence for the trap is just overwhelming. First and foremost, you have severe, undeniable margin compression. That's problem number one. You have a terrible one-year track record of negative shareholder returns, a clear history of disappointment. You have a rapid and risky increase in debt and leverage at precisely the wrong time. And you have to remember, all of this is happening inside an incredibly tough, competitive market. You add all those pieces up, and the foundation just has too many cracks for me. It's a trap. But on the other side of the ledger, I see the opportunity shining through. The revenue base, despite the pressure, has been remarkably resilient. Let's not forget they just posted a record for full-year home closings. They're executing a clear strategic plan for growth and expansion, and that plan is now fully funded. We saw a positive, albeit small, market reaction to these earnings, which tells me the smart money is starting to see the long-term potential. And if you read between the lines, management is dropping hints about an encouraging outlook for 2026. This isn't a trap. This is a company making the hard but necessary investments to build a dominant position for the future. And in the end, this entire debate, the bear case, the bull case, all the numbers we've looked at, it all really boils down to one single powerful factor: time. Smith Douglas Homes is making an explicit strategic trade-off. They are knowingly sacrificing the high-margin, easy profits of today in a calculated exchange for a much larger scale and a much greater share of the market tomorrow. So here's our final take at Iron Financial. SDHC is not a simple value trap. It is a high-risk, high-reward growth play that's just disguised as a beaten-down value stock. Management is making a huge bet. They are betting that they can outlast and survive the current margin pressures long enough for their big expansion strategy to bear fruit. The debt they just took on, that is the jet fuel for that bet. If they're right, if the housing market stabilizes or even begins to recover in the next 12 to 18 months, this new, larger company, combined with that leverage, could supercharge returns for shareholders. But if they are wrong, and this weak market persists or gets worse, that exact same debt becomes a giant, heavy anchor, threatening to drag the entire company down with it. And that leaves us with the final, critical question for you, the investor, to decide. Is management trying to build a gleaming skyscraper on a shaky, cracked foundation, one that's destined to topple when the next economic storm blows through? Or are they painstakingly pouring the deep, reinforced concrete pillars for a fortress, a structure that will not only withstand the current market, but will dominate the entire landscape for years to come? The answer to that question will determine whether this stock rebuilds its value or continues its painful decline. As always, do your own homework. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.